Hello, welcome to a new episode on our podcast, and this time we're going to talk about common mistakes that traders, whether they are beginners or advanced, they do. And we got the best man for that, Nikkhil from Moneytize. Hey Nikkhil, how are you?
I'm good. Thank you so much.
Great. So you're such an experienced trader, and you also run Moneytize, which is a leading academy for traders. And you are seeing from day to day a lot of traders making a lot of common mistakes.
Yes.
And we are here in this episode to avoid them, right? To get people some knowledge. So I want to start with you with overtrading. I didn't know such a term even exists. So tell us about it and what does it mean?
Okay. See, overtrading is a scenario where you do not stop. So basically, it gives you the casino effect, right? If you're making good trades, you're making money, you want to make more and more. So you get more greedy. So you do not stop. And by overtrading, it's not always in your favor. So sometimes initial trades are good setups. You made some money. Now you're not stopping in pursuit of making more money, and gradually you start losing. Now, when you start losing, you do not accept the losses. You want to trade more to recover those losses. So in any which ways, whether you are going for profitable trades or you're going for losing trades, you do not want to stop. So this could be your, now this could be very, very dangerous because this can change your trading personality altogether. Sometimes it becomes habitual trading. So you want to trade because you have not traded today. So whether there is a good setup or not a good setup available, you still want to trade because it has become your habit now, right? So it is addictive. Trading is addictive. So stop the addiction. Do not get addicted to trading. Do not overtrade. You need to define your limits. How many trades in terms of numbers, or what could be the percentage I want to risk on a daily basis or a weekly basis or a monthly basis. You need to have a plan.
Yeah, so it's quite interesting what you're saying, because I think there is a very, very low limit between being a good trader and overtrader. Because sometimes when you are losing, you want to get out of where you are, or you believe in that specific, asset, which is stock, it's a Forex, I don't know, and you want to leave the money there so it will bounce back. So where does the line draws between a good trader and an overtrader?
Everything can be defined only in perspective to your percentage of risk, right? So you have to have a monthly allocation. Okay, this month I'm gonna make money, and to make money, it is never 100% confirmed. The market is totally unpredictable. So in case market goes against me, and if I lose, suppose for example, 10% or 15% of my total capital, I'll stop. I do not keep trading in pursuit of recovering those losses, right? Okay, this could be your monthly target. I want to stop at 10 or 15% of the losses of my invested amount, or this could be broken down into your weekly or daily limits.
I see.
So set your limits. Do not exceed your limits.
Definitely. And there is another term I learned quite recently, which is revenge trading. Tell us about it.
Okay, now revenge trading is, again, suppose I have a bad series of trades. So basically, I've got losses in my trades, right? And mentally, emotionally, I'm not digesting it. I'm not accepting. Now, if you are a good trader, now good trader does not mean you have to win every time. No one can win 100% of the times in the market. Yeah. There will be some good trades and there will be some bad trades. It's a balance sheet. So basically, your track record, your score could be 60-70% winners of your total number of trades, but it cannot be 100 on 100, right? So there would be some losses. Even good traders, they also get losses. On some days are not so favorable days. Some trades are not so, even though we qualify the trades before entering into the market, but still market is totally unpredictable. It changes without any advance indication. So if we get a bad trade, if we get a loss-making trade, accept it. Now, I have a bad trade. I've taken a bigger lot size. I've not controlled my risk. Now I am under pressure, emotional and mental pressure to recover this loss. I want to take revenge from the market. I want to recover my losses on the same day. And in pursuit of trying to recover the losses, I'm going rash. I'm going random into the market. And random trades without any proper analysis, without any proper planning, it might result in heavier losses. So this is a negative spiral you get into. And losses after losses, you start trading, you keep trading, you keep trying to recover, and the recovery never happens.
Definitely. And you mentioned one of the way to avoid it is just to make your limits for the day, for the month,
Yes.
for the year, for etc. What are other strategies you would recommend traders to avoid these pitfalls?
Okay, number one, you should have a plan in advance. Trading is like any other business, right? So tell me one thing. If you want to start a new business today, would you make a plan, or would you just jump into a new venture randomly?
I will make an 80% plan, let's say. I won't plan everything, but I will definitely plan.
So you need to have a blueprint, right?
Yes.
You need to create a plan.
Yeah.
Start working in the reverse order. So this is my destination. I want to make X percentage of returns every month, or I want to make X amount on a monthly basis. That could be, again, reversely calculated in terms of percentage on your investment amount. Now, how will I achieve this percentage on a monthly basis or a weekly basis? You need to break it down. How much risk I'm willing to take per trade and overall. Per trade risk, overall risk limit, your monthly or weekly risk limit. Now, how to qualify setups? How are you going to know whether this is the right trade you're going to take, or you're just going to enter because somebody said, okay, buy gold, this is good, and you randomly start buying gold even though gold is sitting at a very high price?
Yeah.
And the probability of gold is, okay, it can crash before going higher. You didn't know about it. You have no idea about the behavior of the market, behavior of that particular asset class. You are blindly following the trade calls or the trade advice given by some XYZ third person. No, you need to have your own analysis. You need to be expert in this. And risk management is the key, is the one line answer.
Definitely. And what are other tips on risk management you can give to our listeners?
Okay, risk management. So whenever you enter into the market, make sure that you have very strong risk management system. It could be in terms of per trade risk. It could be in terms of total risk and the reward, so the risk to reward ratio. So for example, if I say, okay, I want to buy X product at $100 because I feel I've done my analysis, and as per my analysis, I feel that this product price can rise from $100 to $120. So how much is the potential profit? $20. And in case market does not behave as per my expectation, I will exit from the market when market drops to $90. So what I've done here, I've again defined my risk. So my risk in this potential setup is $10, but the potential reward which I aim to collect from the market is $20. So it's a very healthy setup. Why? Because my reward is bigger, double than my risk in this trade. I've seen traders who are willing to make $5, $10 per unit, per trade, whatever. And for making $5 or $10, they have no limits. They risk everything. It doesn't make any business sense.
Yeah.
Tell me one business where you're willing to put everything in one shot for making smaller gain and you lose everything. No, it's not the right method. Your risk to reward ratio should be healthy, where your reward should be always bigger and higher than the risk you are putting in one trade.
Definitely. There is one tool that a lot of traders use, which is stop loss. A lot of people do that.
Yes.
What is the right strategy to use stop loss in a way that will allow us to enjoy the profit and not avoid any profit?
Now stop loss is actually dependent on the price behavior of any asset you want to trade. So you need to refer to the chart. So you have to have some knowledge about chart analysis. There are some good levels where we can see, okay, that market has bounced off from. So historical price level, which is in technical language, we call it as support. So in general, I can tell you, like, if you are going for a buy trade, you need to understand how far is the nearest support. So support will basically protect the price to go further down. So in case support gets broken due to some reason, due to some fundamental reason, due to some sudden change in the market conditions, okay, then your stop loss is generally lower than the support price. So that in case support gets broken, there is a higher probability of the price going further down and you move out. So stop loss is the predefined level of the asset you want to trade, the price level, where you want to accept your loss, you want to limit your loss and move out from that particular trade.
Yeah.
You cannot hold your trades in hopes. Okay, let me hold this trade. Maybe today I'm in loss. I'm hoping that tomorrow market gets better. No, this is not the method to make money from the market. So some traders, they do not apply a hard stop loss, means they do not define in their trading system where they want to exit in case market goes against them, but they're mentally very strong. So they apply a mental stop loss. So use either one form of stop loss, either a hard stop loss you can define in the trading system in advance when you enter into the trade, or if you do not want to define your hard stop losses, use your mental stop loss. If you have reached your X percentage of losses, you're basically your loss limit, move out, accept loss and move out.
Definitely. And I know that there is a lot of people that do common mistakes regarding lot sizes.
Yes.
So I want you to give us some of the mistakes you are seeing.
Okay. Now, lot size is basically the contract size of the trade you want to buy or sell with certain direction in mind. So let's say I have an asset on which I've done my analysis and I believe it's gonna go higher. It's bullish and the market price will rise. Okay. Now, for example, if I started with $10,000 as my initial investment, I cannot go all in one trade. Although there is a probability that market price will go higher, but there is no guarantee. What if the market goes down? And if I'm going with a very big contract size, hoping that I'll be making a bumper trade, one big trade, which gives me a very good profit, and it turns around, you'll be ending up in big losses. So if I get into the trades with a pre-calculated lot size, so my formula is I never risk more than 1% per trade. So in case if I lose only 1% from my total amount invested in the market. And I need back-to-back 100 bad trades to lose 100% of my investment amount.
Yeah.
Okay, which is again next to impossible. So even if you enter into the market randomly without doing your pre-research or analysis, getting 100 bad trades on a 1% calculated risk back to back, it's yes, it may happen, but not so easily. So we calculate the percentage of the risk we want to take in one trade, and to maintain that percentage of risk, how much should be the quantity of that particular asset which I'm going to buy or sell. So there are lot size calculators which are available, which is also free of cost, given on our Moneytize website. I recommend every trader, before setting up a trade, should use the lot size calculator to limit the losses.
Amazing. Definitely a good tool. And we talked a little bit about it, but maybe you can sort it out for us. How can a trader can develop a good, solid risk management policy for himself?
Okay. Again, risk management policy, first thing, you need to have your plan, how much you want to make from the market, and for making that particular amount, how much is the total amount of risk you are willing to take? You have to define it. And suppose market kicks you to the limits, market pushes you to the limits, right? You have reached the limit. You have to stop it. Number one. Number two, this is on the macro level basis, like total amount of risk. Now you need to do your micro management. How much risk you are willing to take per trade? Sometimes I get very high quality tradable setups. I'm willing to take 1% risk per trade. Sometimes I get not so high quality tradable setups. So not every time you will find 5-star setups on the charts. Some charts, they are qualified with 5-star setups. Sometimes the market condition is such that you are not getting a 5-star setup, but you're getting a 3-star or 4-star setup, and you do not want to miss the opportunity.
Yeah.
So in that case, I break my policy of 1% risk to even smaller. So basically in those cases where I'm not getting very highly qualified tradable setups, I enter into the market with 0.5% risk. So I'm taking even lesser than my predefined risk limit.
Yeah.
Right? So this is you're preserving your capital. It is a game. Preserving your capital is very, very important. If you lose all your investment amount, if you lose all your capital, then how are you going to make money from the market?
Definitely.
Right? So I generally say it is a game of longevity. Okay? How long you stay in the market, and market does not kicks you out.
Definitely.
Okay? Some traders, they want quick returns. One trade, bumper trade, mega. Oh no, it is a game of consistency. It is a game of longevity. You need to make consistent returns from the market on daily basis. One bumper trade, you make good amount of money. One bad trade, next day you lose everything. So what's the fun? You're making money and you're giving money back to the market.
Definitely. Let's talk a bit about something that's very interesting as well, which is recency bias. Another, I'm noticing a lot of psychology motives in
Yes.
this with the trading business. Tell us a little bit
Because
about it.
online trading is a very emotional business,
Yeah,
right?
I
So
see.
we get carried away so easily. So recency bias, okay, now let's say you have just started trading and your initial trades, they were really good. So 2, 3, 4, 5 trades, they were really good. Now you become so overconfident. You say, oh, I know how to make money by online trading. I'm the champion. I'm the master. And you think that no one, and there would not be any scenario where you'll be defeated, right? So market will be always kind to you. And whenever you see, you buy, you sell, you're making money. So you get super overconfident. Now, why this happened? Because of your recent results. So we call it as recency bias. So recently you got some good trades, a sequence of good trades, and you get carried away. Then you stop applying risk management techniques. You think, oh, I'm making money. Let me go with big trades, bumper trades, right? And suppose market turns around and now market is not so kind. Market is not so favorable. And now you start losing money. Now, because of a sequence of bad trades, your confidence shatters. So even if you're applying the chart analysis in the correct way, in the correct method, but you're not able to maintain your winning streak, now you have entered into a losing streak. Now, because of the recent bad trades, again, you are emotionally disturbed. You are mentally disturbed. And you start doubting yourself whether I'm able to read the charts correctly or not. Yes, you are doing it correctly. The only problem is your recency bias is affecting you.
Definitely. And it's something that, I'm seeing a lot of maybe confusion. Maybe you could sort things out for us between leveraging and margin, which a lot of people, sometimes mix between the two,
Okay.
right?
Now, in Forex market, most of the brokers, they offer leveraged account. Now, what is leverage? Leverage is basically the broker is saying, you do not have to pay the full price of the asset you want to trade. You just pay a fractional amount. Now, how much is that fraction would be? It is dependent on the ratio of the leverage given by the broker. So, for example, your broker is offering leverage of 1:10, means he's offering 10x leverage. And you're buying a contract, electronic contract of XYZ product, and the contract price is, let's say, $10,000. Now, if there is no leverage, then you have to pay full price to get into the contract. The product is 10,000 and you have to pay 10,000. Now, because your account is leveraged 10x, so what is the number I've mentioned here? 1:10. It is leverage is always mentioned in ratios. So our account is leveraged 1:10. So how much margin is paid? The margin would be paid 10,000 divided by 10. So basically you're going to pay 1,000 margin to enter into the contract. So margin is calculated by the total product price or the contract price divided by the number of leverage ratio. Now, once you are done with the trade, either you will end up in profit or losses depending on the market direction.
Yeah.
Okay. The profit or loss amount would be added or subtracted from your account accordingly. And the margin payment which you have made at the time of opening the trade would be reversed, because we are doing electronic trades. Basically, we are doing CFD trades. CFD trades, we are not buying or selling the products here. We are not getting the ownership here. We are just making a contract just for the speculation here.
Yeah.
So because you have not purchased anything, you have not sold anything, the margin payment, which is taken as the initial deposit to open the trade, is now reversed because your trade is done. It's closed.
Yeah. Amazing. So this is the difference. And, we talked about many biases and maybe a lot of psychological phenomena within trading. But I'm noticing there is a lot of traders that jump from strategy to strategy. They have one strategy today, next strategy tomorrow. They are jumping between those. Do you recommend changing strategies? And what do you think about people that do that?
Okay. Now, if you want to become a good trader, you need to be consistent, right? And thanks to internet, thanks to YouTube, we have thousands of trading strategies available. And most of the beginners, they go to a YouTube video or internet content and they find a tradable strategy. Now, they have never done it on their own. So they are basically relying on a method of trading. So trading strategy, which is given to them. Now, when they start applying initial few trades, they find good results. Then there would be phases there when they stop getting good trades, when they stop getting good results. Now, they are unsure whether they are using the right strategy. They are making some mistakes. So they doubt. So instead of correcting their own mistakes, they start doubting the strategy itself. And then they quickly hop on to the next strategy. So they go to the next YouTube video, they find a new strategy. Then again, they take a few trades. Sometimes they do well, sometimes they do not do well. Then they hop on to the third strategy. So they keep hopping from strategy 1 to strategy 2 to strategy 3 in pursuit of finding the perfect strategy. Now, there is no perfect strategy. There are good days and there are bad days in the market. So all strategies, they will have good results and bad results both. Right? You need to stick to them. You need to basically check. You need to assess whether this strategy is working or not by consistently applying that strategy. So I usually say that you need to check your assessment. You need to do your self-assessment of the strategy you have applied by sticking to at least 40 or 50 trades based on one strategy. Do not jump from strategy 1 to strategy 2 after every 4 or 5 trades. It doesn't help.
Definitely. I think it's a very good rule of thumb that you just gave here. And another psychological thing, emotional based decision. A lot of people do that. You just mentioned that before, that you are on a winning streak. Let's say that now you are doing something which is completely different, or you are doubling your risk, etc. And sometimes when things don't go very well, people are changing their minds as well. So what do you think that emotions has to do with trading?
Your recent trading results, they definitely play an emotional role, because you get carried away by your recent results. Apart from that, sometimes there are other emotions. So for example, I've seen some traders who are in need of money, right? They think that they will get rich quick overnight by online trading. Now you have some financial requirement. That's your financial requirement. Market has nothing to do with it. Market would not be extra kind to you. Oh, let me be kind to this trader because he needs money. No, you need to follow the system. So system is going to make money for you. Your financial desire, your need, your emergency, market has nothing to do with it. If you start losing money because you have started taking high risk because you are in financial emergency, so that does not allow you to go with high risk. Now, because you've started taking high risk trades and you're not winning money, now you're under tremendous pressure, tremendous stress. Because you have started losing the amount. Instead of making more money, you have started losing money. And now you are under emotional, or you can say your greed and fear factor is playing a very big role. And now you're under your emotional mountain of pressure. Yeah. Right? So do not allow emotions to kick in. You have to be mechanical. It is really difficult. We are human beings. We are emotional beings. So it is really difficult for a person to be a mechanical and behave like a machine. But yes, this is how we make money in the financial markets. You can beat the market only if you stick to your risk management rules. You can beat the market. You can make money from the market mathematically. So you need to have your numbers strong, and you need to have a strong defined setup, your management thing, your plan. It is your full-time business. If you want to make money, you have to behave like a businessman.
I've seen in newspapers all these broker games where there is like a series of 7 traders or 8 traders, and then there is the monkey, which giving just a random stocks he's taking, and then he wins everybody, just by sticking to the same stocks, not selling, not buying, just sticking to the same thing. So I think it's a good example here of seeing how much is a more mathematical game than an emotional game, right?
Yes. So you can beat the market only mathematically. Now, how? Again, the same steps. You need to define how much risk you're willing to take per trade, how much reward you're aiming at. Sometimes I've seen when you're making money, you're not willing to realize your profits. Why? You get more greedy now. So your account is already running in profit and you get more greedy. Oh, let it grow. I will make bigger profit. And next day market suddenly changes. And whatever amount you were making on day one, now you start losing. So it's always to collect your profits at the predefined levels. So you were ready to collect the profit before entering into the market. You decided that, okay, today I'm going to make $500, and you already made $500, but you did not realize.
Yeah.
And you let the market hit you back. And market now, instead of giving you $500, the market has maybe takes back $1,000 or $2,000 from your pocket.
Exactly.
Do not allow the market to take money back from you.
Definitely. And let's maybe give some examples of what is a good trade setup and what people need to in order to qualify to a good setup.
Now we need confluences. Basically, when you're doing your chart analysis, which is the best form of analysis I believe in, we need to gather more and more confluences. So if you have multiple parameters giving you the same direction, showing you the conviction in the trade, it is called a good quality setup. So higher the number of confluences, better the quality of the setup would be. Now, in terms of technical language, suppose the market is right now sitting at a underpriced level and you want to go for a buy trade. Makes sense. It is a confluence. You always make money by buying the product at a lower price and selling at a higher price. And market has given you the opportunity by pushing the prices lower. Number two, you see a good news in favor of that particular stock or asset, right? It is a second confluence. You wanted to buy this stock. There is a good news. There is a good, basically, fundamental factor which is now helping you to buy this stock, because now you believe more in your conviction because of the good news. The stock market is expected to rise. The stock price was already at an underpriced level. You can add your chart analysis and you can use different techniques of demand, supply, support, resistance, the technical terms. And if you have a confluence of all those factors, go for it. And the best is, the biggest of all, you need to evaluate how much is your risk and reward. So if it is a good setup, it will be less in risk and high in reward.
Amazing. And you just mentioned the good news about how can news change the way we look at the investment or look at the trade or a setup. What do you think the role the journalists play on the trading world?
Okay, now journaling your trades is must. That will give you a self-assessment thing. Because suppose sometimes what happens, you start losing and you have no idea why did you lose the trade. If you're journaling, you will maintain, okay, before entering into this trade, I have seen setup 1, 2, 3, 4. So following are the parameters which were completed. So I entered into the market because all setups were available. All confluences were there. The setup was a high quality setup. But suddenly there is a news and market changed. No problem. You will not change your method for the next trade. Whereas if you enter into the market without journaling, you have no system of qualifying the trades. You randomly buy or sell something and you make money. And if you lose money, you have no idea why this trade went in the negative direction. So why this trade went against you? You have no idea because you have never made a system of qualifying the trades. You have never journaled it. Now you do not know whether market was bad on that particular day. There was some news event which impacted you, or whether it was your bad decision. Sometimes we qualify the trades, we get stopped out, we hit a loss, that's fine. Come back and repeat the same system. Sometimes you're making money but without any idea, without any system, that's bad because you have no idea. It was something which we call as a fluke. You made money by fluke. And if you're making money by fluke, you will lose money fast.
Yeah, definitely.
If you're making money by method, you will retain it.
Definitely. And also if you understand what you've done.
Yes.
So if you followed something and it actually worked and you can repeat that process.
Exactly.
And sometimes that process works, sometimes it doesn't. It's also part of the process. But the fact that you have one.
I generally tell my clients, when you drive your car, right? So you follow the rules of the road.
Yeah.
Right? But still, sometimes someone else comes and hits you on the road. It's not your fault. Someone else's fault, but you got hit. That's fine.
Definitely.
It's not your fault. You keep driving in the same manner. But if you're not following the rules of the road, then it's your fault.
Definitely. And I understood that on the trading world, you can't be you can be the only one taking the risk, but you can have some other people helping you, like an accountability partner or a mentor.
Exactly.
Tell us about those things because it sounds very interesting.
It plays a major role. See, sometimes what happens, we get carried away, right? And we do not know where to stop, what to do. So you need to be accountable. So this works. Because if, okay, now accountability partner could be your friend, accountability partner could be your family member, if you're married, could be your spouse, or maybe your mentor, your teacher, because you are accountable for the losses. You need to hold yourself accountable to someone.
Yeah.
This will maintain a restriction. So you will not freely lose money. You will not go rash into your trading style. Because if you are not answerable to anyone, you tend to make more mistakes. You tend to get more greedy. You tend to do over trading, revenge trading, all those mistakes.
Definitely.
Right? So find your accountability partner, and you should hold yourself accountable to someone. This will definitely improve your psychology.
Amazing.
And keep a check on your emotional thing.
Amazing. But will it also, create some sort of fear from investing? Because you say, hey, I don't want to say to my accountability partner that I did this or I did that. So maybe it also affects you as a trader.
See, fear is basically when you are ignorant, right? So you don't know what went wrong. But if you have a method, if you have a process, if you know, if you're not ignorant, you know how market works, right? And this time market failed due to XYZ reason. So you have a reason for that. So you can go back to your partner and say, see, this trade was a good setup, but suddenly there was some news in the market. There could be some other event which has changed the market conditions. So it's a result of that particular event. Now, next time, you do not need to reinvent the wheel. But when you do not have a system, you are ignorant, you don't know what worked in your favor and what did not work in your favor. Now you'll be fearing to give answer to your partner, because you entered into the market randomly without knowing about it, just to make money with hopes and anticipations that you'll be making money by trading or over trading. No, it doesn't work like that.
Definitely. And I want to ask you, can you give us like top 3 tips for someone that wants to avoid the common trading mistakes?
Top 3 tips. Number 1, start with your trading plan. Trading plan is the first step. Start working on your trading plan. Okay. So how much is the total amount of risk you have decided? You have to stick to it. How much you have deviated from your plan? Get back to your plan. And number 3, again, accountability. So you need to find a person in your life to whom you will be accountable. So all these things, and don't get into over trading, revenge trading, maintain your risk to reward thing. You will come up as a very good trader.
Amazing. Very good tips. And coming to the end of this podcast, Nikkhil, what final thoughts do you have for new and experienced traders to avoid the common mistakes?
The new and experienced traders, number 1 thing, they usually get into addictive trading. Stop the addiction. You do not allow yourself to get addicted to trading. This is not a money-making machine, or if it would have been so easier. So I generally say, remember one thing, less is more in trading. Okay, so you need to select less number of trades, but high quality trades. More is less in trading. If you do more number of trades, you will not make more money. In fact, you can lose more money. So remember, less is more in trading.
Amazing. That's a very good tip. Nikkhil from Moneytize, thank you so much for this episode.
My pleasure. Thank you.
Thank you so much. Thank you so much for listening to us. See you next time. Bye-bye.